And welcome. This is Mary Ellen McGonagle with your Friday afternoon MEM Edge show. And of course, this is the show where we bring you where the action is in the broader markets, and quite an impactful week this week, of course, as we head into a market period that is not looking constructive. So let's go ahead and get started. I'll share with you today, as usual, we are going to take a look and see where did we close the week for the markets and what we can anticipate going forward. Of course, that is the idea for this show. We want to not only share with you what occurred last week, it's all with an eye toward helping prepare you for going forward as well. So we're also going to take a look at some of those top headline news this week that drove price action, and also beyond that, other very impactful news that is causing the markets to, at the very least, pull back. So let's take a look at some of those headline news this week. Earlier, Fed Chair Powell did testify in front of the House and the Senate, and he did say that elevated interest rates are in the cards at this point in time, simply because inflation remains sticky, it remains elevated. So that in turn, of course, pushed the markets lower. Last week's late week rally was negated. So we also did get news relating to employment, and this is a very big sticking point for the Federal Reserve. They want to see that job growth slow. Increase in job growth means in continued spending among consumers. So this is a very important area for them. We did see private sector job growth pick up in February. That was on Wednesday. And outside of that employment report, there was news from China that they were proposing a possible lockdown again due to a flu epidemic. And this was highly impactful. I'll share with you which areas of the markets saw the most in the way of response. Also, we did see news today that U.S. jobs did gain in February, not what we want to see. Interestingly, the unemployment rate did rise. So it was a little mixed. Certainly, economists came out following that release saying that there were potential bright spots within that employment number for February. However, a much more impactful event took place, of course, with Silicon Valley's banks collapse. That was the certainly big news leading into yesterday, Thursday, into Friday. Next week, another big week. We do get that core CPI. This is another important metric for the Federal Reserve, and that will come out on Tuesday. Outside of that, next week, retail sales, industrial production are due to report. Not quite as impactful, but certainly that core CPI, we will have all eyes on that. So let's go ahead from here and take a look at the markets and see where did we close for the week. So here we are with the daily price chart of the S&P 500. And we can see this is the deterioration that actually started earlier in the week and continued. So a couple of notes here that we need to be aware of. First up is the fact that the S&P 500 is now below any possible area of near-term support. We did break below that 50-day simple moving average very decisively on Thursday. Continuation to lower levels below that 200-day simple moving average as well. And then, of course, today's price action, we're down another 1.5% today. Actually, I can refresh this screen, but the bottom line here is that we now have that RSI very much in negative territory. Likewise with the faster moving stochastics, which never got into positive territory and now are further below. They are in an oversold position. You can use historical precedents as your guide, because when these faster moving stochastics get into an oversold position, you oftentimes will see a relief rally of some sort. So that is a daily price chart of the S&P 500. From here, I am going to share with you a view of the NASDAQ. And actually, I will go back here and let's just take a look at a chart of the NASDAQ using a daily price chart to highlight this break below the 50-day simple moving average, and other metrics to be under consideration here when you're looking at the broader markets, and they are beginning to break and close below key support. You want to keep your eye out on that volume characteristics because higher volume days indicate distribution, and the S&P 500 had been showing a fairly large number of distribution days together, which had been relieved. So if we do get up to 5 or 6 days of distribution, and that's defined as the market's falling on volume higher than the prior day. So if we do get 5 or 6 distribution days in a 4-week period, that is not good news. It can signal further downside. So we are keeping an eye on that as well. So here we are with the NASDAQ now also breaking below near-term potential support. I do need to point out from here, your next area of possible support is going to take us down to this late December, early January low. So potentially a fair amount of further potential downside from here. But let's go ahead from here and also take a look at when the stochastics get into an oversold position. We need only go back to this late December period, and what you need to be on the lookout for to, at the very least, signal that we are stemming losses and then potentially turning. This is something I'll be covering very, very closely in my Sunday MEM Edge report. A lot of areas oversold after this week's sell-off, and you're going to want to know what to be on the lookout for to signal, at the very least, that we are stabilizing and potentially getting our footing back. So let's take a look now at that NASDAQ composite. A little busy here, but this is a daily price chart that is going back quite a bit in time. What I wanted to do here is highlight the fact that when we have a negative relative strength indicator, that's that RSI indicator, and then you couple that with a negative stochastics, that's the stochastics entering into below 50, oftentimes this will point to lengthier pullback than normal. So going back to this period at the end of 2020, we did have that fall pullback in the markets, and then into 21 and so forth. You can see that the declines on a basis here is 8% was the least peak to trough pullback. But from here, we currently are now 9.1% on the NASDAQ, below this early February, late January peak. So we've already put in quite a bit in the percent change downward relative to historical precedent. So of note also is what to be on the lookout for as it relates to a potential turnaround. So I did want to point that out to you as well. From here, let's go ahead. We're going to take a look at the underlying 11 sectors in the S&P 500. I've gone ahead and added this RSI indicator, and this is a 2-month daily price chart view. And as usual with this view, we are on the lookout for rotation, areas that are relatively outperforming, and those that are just truly down and out on this lower quartile. So let's take a look. Technology up here in the forefront, and it did outperform this week. The tech sector was down 3.1%. That's relative to the S&P and NASDAQ that were down about an average of 4.8. So we did see technology a relative outperformer. So as we move through this, I will share with you where within tech we did see a little bit in the way of outperformance, and it is an area that I'm very focused on at this point in time as it relates to looking for stocks that are going to outperform when the markets turn. So from here, let's go ahead and move forward and take a look at some of these other highly impactful moves in some of these sectors. And first up here is basic materials XLB, and the overall sector was down 7.6%. I'm pointing this out because it was a big outperformer last week, and we were up here at this near-term high, looking very constructive. Now, the materials sector, as you may recall, last week was positively impacted by very constructive news out of China relating to their manufacturing data. They were at about a 10-year high. So things were looking very good as it related to possible demand from China for these material names such as steel and so on. This week, we did see a sell-off with the markets as well, but the heavier sell-off was due to that news out of China that they were reconsidering a lockdown again. There were other factors as well, but it certainly did push the material sectors and those steel names and other areas down quite a bit. Some other areas that we can take a look at here, utilities and staples, kind of up here in the forefront. They were outperformers, down about an average of about 2%, certainly down quite a bit less than the broader markets, but still not anything to get excited about, in the sense that here we are with utilities, that downtrend still very firmly in place with negative momentum characteristics. The point here is that there is not a need, or certainly I would not suggest that you run into these staples whole-handedly, because overall they are still showing deterioration, a declining lows below these key moving averages. I will share with you a couple of staples names that are faring well if you were inclined, but overall there is still quite a bit in the way of a downtrend taking place there. Another area, of course, that we need to take a look at here, this is XLF, the financial sector, and of course SIVB's collapse. There is a fear that we may see spreading into other banks, but I will be talking quite a bit about this in my report as well, in the sense that Silicon SVB Financial, their situation, while not while dire, is very, very unique. So I'll take a look and really share with you some more insights as it relates to this pullback in the financials. I'm going to also share with you, as we move forward today, what an oversold banking index looks like and what to be on the lookout for a possible turnaround. Unfortunately, we do still have that inverted yield curve, which is a big backdrop and a reason why bank stocks have been deteriorating, but we'll get into that as we move forward here. So let's take a look at a couple of other areas here as we move through, because beyond these sectors, I do want to share with you some of these sub-industry groupings to give you a better feel of underlying price action here. Again, a 2-month daily price chart view and that relative strength indicator, so that we're sorting these in relative strength. It's not going to take into account just last week's price action. It will go back further beyond that. But let's take a look. Volatility certainly front and center. Up here, we can see we did have that spike in volatility up to 29. And then as the day progressed, we did fizzle down a little bit lower. However, we did close the volatility, or VIX, above this 200-day simple moving average, and that is impactful. If you go back, let's see if I can pull up a longer term daily price chart here, and if you can cite here prior periods when we close above that 200-day simple moving average, historically more volatility ahead, certainly over the near term. Let's take a look at another area that was certainly a relative outperformer, and that is gold. This is all about that flight to safety. And we did see an initial move into gold on Thursday with SVB's news, and then even more pronounced today. We can see your momentum is in positive territory with that RSI, with GLD, the ETF for gold stocks. Now, let's take a look, because here we are. This is the yield on the 10-year. I'm using TNX, and we can see a pretty big drop, down 6% today. That elevated interest rate environment, not good for stocks, particularly growth stocks. However, this drop today is another flight to quality, where individuals retreating from the stock market and entering into the safety of treasury bonds. So we did see a drop here in that 10-year treasury. So keeping an eye on that as well. Let's go ahead and take a look at some of these other areas that were really down and have been down in this lower quartile, indicating relative weakness. First up is IWM. That is the Russell 2000 index, and it was down 8% this week. And so that already had been an underperformer. In essence, two things at play here. When you see small cap stocks deteriorate, it is generally a risk off sentiment that's being signaled. Small cap stocks, a lot of these companies are quite volatile. They will have earnings, but when you see small cap stocks struggle, it is indicating a move away from these riskier names, and we can see a clear-cut drop here, so a pretty significant decline. Another factor to keep in mind with Russell 2000, if you were to Google, for instance, this is something I happen to know because I work with small cap hedge funds, is that a big percent of the underlying stocks within the Russell 2000 are bank stocks. A lot of people might not be aware of that, but so that is another reason. So from here, let's take a look at another riskier asset class, and that is biotech stocks. This is IBB, the NASDAQ Biotech ETF, and this is another area down 6.7%. It had been negative going into this week, a little bit of a late last week rally that we did experience, but it is back down. So overall, high volatility, underperformance in biotechs and small caps. So overall, of course, it is signaling and broadcasting a lack of confidence in the near-term prospects for the market. So from here, I did want to share with you on the banking side. I did mention that I would have us take a look because this is something that is still very, very clear in my mind. I remember it quite well. This is KRE, the regional banking ETF, and I'm going to take us back to the bear market in 2020. And quite simply, you can see how KRE pretty much fell off a cliff. This is much more deterioration than we saw in the broader markets. And quite simply, there was a fear in the face of an unknown killer virus, whether we would see a lot in the way of mortgage and other loan defaults. So banking stocks really fell out of bed. In the initial phases, there were some rally attempts, but severe underperformance, certainly relative to all those tech names that went on to great heights. So what I did want to share with you, because my MEM Edge report, we participated quite handsomely in the eventual turnaround in these regional banks. So I'm not suggesting that the current sell-off that took place recently here is going to take this long to recover. This is more give you a sense of what to be on the lookout for that would signal that bank stocks were in fact ready for prime time. So in that November 2020 period, what took place here was that banking stocks were reporting numbers. Their numbers were negative. However, they were much higher than expected, and that in turn pushed these stocks up. And SIVB was a big winner for us coming out of here. We had about three heavyweight super regional banks that were real top outperformers. Bigger point here is taking a look at KRE in particular, moving back above these simple moving averages, in essence, creating what's called a golden cross. When your shorter term moving average moves above that longer term, we have positive momentum here. This is a daily chart on the RSI, and then likewise with that MACD black line up through the red on the MACD. So we had multiple characteristics, but most of all, it was confidence that bank stocks were back. We had the worst behind us. Loan defaults were not there. And indeed, they were able to move higher. Now, one other thing that I can point out to you, let's see if I can segue. Well, before we do that, I do want to share with you where we are currently with KRE, kind of zoom in quite a bit more here. And you can see this is this steep sell-off that took place this week. We can see this oversold condition now in the RSI with this regional banking ETF. And certainly there is anticipation that we will see a leveling off at some point in time, a lot in the way of oversold conditions. From here, it's going to be all about uncovering and having your arms around those bank stocks that are not going to be as impacted. And certainly the larger JP Morgans of the world have a different structure. They receive income from either their credit card division, their trading division, also M&A activity. But there are other areas as well that I will be staying on top of here with this oversold position that is currently shaping up here. Now, what I also want to do while we were here is take a look at XLF. And I'll share with you how you can do this and go ahead back to we want to see 08, 09. We are not in that condition by any means. Let me make that clear. 08, 09 was a period when the banking system very clearly collapsed. We are not there. That is not the situation. But what I do want to share with you is what to be on the lookout for and the movement that got that banking area back into play. So here we are with XLF, that's the financial ETF, taking us down to this trough period here in March of 09. And I do still recall the headline that really got XLF, and most importantly, this time back here in 09, it got the broader markets back. And that was that one of the major U.S. banks announced that for the month of January and February, they had seen positive growth taking place. And there also was news at this point in time relating to the rulings around the way banks were able to establish and report their numbers. So two factors, two major news items did bring confidence back into that banking area, and then hence the broader markets. So from here, let's go ahead, and I am going to share with you areas that I am keeping a close eye on relative to what to be on the lookout for with the broader markets and names that are at the top of my watch list. I'm going to start here with I talked about some of these consumer staples names. This is Church & Dwight. CHD is the ticker symbol. Now, here with StockCharts.com, we can go ahead down and ask for what is called a full quote. And the reason I'm doing that quite simply is you can then get that dividend yield, 1.3%, not overly exciting, but let's take a look at good old Hershey chocolates. Not the best looking chart, but certainly relative to what we have been looking at. It has a nice 1.7% yield. The reason I'm highlighting both of these companies is they did report nice earnings. So there is growth in place in addition to offering that more defensive staples type of environment. Here we are with Arista. This is Altria, MO, the tobacco company. This was a misprint here, but we can see it is holding in really quite well. And this one offers a 7.9% yield, so quite a bit healthier there. Another area that did exhibit and retained its outperformance for the week were some of these home builders. Here we are with DHI, and you can see that it broke back above key resistance up here in positive territory with that RSI. This is all about analysts and investors looking out beyond the beginning first half into the latter part of the second half. There's a general sense that we could see this area come back into vibrancy. They've also been, that's not the best looking one, but certainly some of the others in this space held in fairly well. This is Lennar. And also I did want to share with you other stocks that are looking quite interesting. This is GE, gap up. Management reiterated their growth prospects going into this year. Last up, I'm going to share with you areas that I have on the top of my watch list right now, and it is going to be companies that reported strong earnings, they have strong growth prospects, and they are holding in relatively well. And certainly I did not share with you on the tech side. So let's do that before I need to close out. This is the Semiconductor Index. While it did decline this week, certainly less than the broader market, there is vibrancy within that area. Also in technology, you may not be aware, but alternative energy equipment stocks are a part of that tech group. Take a look. This is for solar. It had this gap up on earnings and is holding in remarkably well. I will leave it at that. If you have not already, go ahead and use that button below to trial my MEM Edge report. I will fine tune even further what we need to see in these markets and where that watch list is pointing. Have a great weekend, and I will see you here next Friday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.